Welcome back to Winning by Not Losing, where we break down the markets, investing, and how to stay ahead without unnecessary stress. The last week of February 2025 has been rough. The markets took a significant hit, volatility is up, and we know many investors are feeling uneasy about what's happening in the markets right now. Today, we're joined by Sudhir Holla from My Stock DNA to break it down. We'll talk about the reality of market drops, why they happen, and most importantly, how investors can protect themselves without making emotional decisions. Sudhir, welcome. It's been quite a week, hasn't it?
It sure has. But here's the thing, this kind of volatility isn't unexpected. It feels intense in the moment, but if we step back, we see that this kind of volatility is normal for the markets, and one can argue even healthy at times. What's most important in times like this is not panicking and instead understanding what's happening beneath the surface.
Exactly. And that's what today's episode is all about, helping investors take a deep breath and see the bigger picture. So let's start with something you've mentioned before, comparing the stock market to running a race on a hill. For those who haven't heard this analogy before, explain it to us. Why do you compare investing to running on a mountain trail?
Think about it like this: if you're running up and down a hill, your biggest challenge isn't just the uphill climb, it's avoiding ditches along the way. If you trip and fall into one, you have to spend way more energy climbing back out. That's exactly what happens in the stock market. If your portfolio takes a deep dive, you're not just losing money, you're losing time. And time is your most valuable asset in investing.
So the key is avoiding major losses, rather than just chasing big gains.
Exactly. The goal isn't to never experience volatility, that's impossible. The goal is to minimize the damage when markets turn rough so you recover faster. Now, let's talk about the two types of runners on this trail because they represent two types of investors. First, you have the aggressive, brave runner. This is the investor who sprints ahead, taking higher risks in search of the fastest way to the top. They invest in high growth stocks, leverage, and momentum plays. When the trail is smooth, they look like champions. But when the terrain shifts, steep declines, unexpected ditches, they may risk falls that take time to recover from. Then there's the defensive, cautious runner. Right? So this investor is measured, focused on consistency rather than speed. They take calculated steps, allocating more to stable investments like bonds, gold, and defensive stocks. They won't get to the top as fast in a bull market, but when conditions get rough, they stay on their feet and avoid the worst drops.
So both types of runners are trying to reach the same goal, but their approach is different?
Exactly. The UMI conservative model is represented by the defensive cautious runner, and the UMI growth model is represented by the aggressive brave runner. Both react differently, and both approaches are valid depending on how you emotionally react to risk. Right now, investors are asking, is this just a minor dip or is something bigger happening? In our framework, we call this assessing whether the market is just tired or having a heart attack.
All right, let's get into that. What does it mean when you say the market is having a heart attack?
This is a concept we've discussed before in a previous podcast, but it's worth revisiting, especially given the current market environment. Not every downturn is the same. Sometimes the market just needs to catch its breath, a temporary pullback before continuing higher. But other times, it's a deeper structural issue, which means more prolonged pain. This slide, which we've used before, lays out the different economic regimes and how various assets behave in each scenario. The key to understanding what's happening right now is recognizing how money moves depending on the environment.
And where does money go when markets drop?
That depends on the type of downturn we're experiencing. Money follows predictable patterns, flowing into different asset classes based on economic conditions. The three major destinations are stocks, bonds, and gold, and their performance is dictated by whether we're in a period of inflation, deflation, economic expansion, or contraction. Stocks perform well when the economy is strong and growing because corporate earnings are rising. Bonds act as a hedge in deflationary or slowing economic environments, offering stability when interest rates fall. Gold becomes a preferred hedge during periods of high inflation or economic uncertainty when investors seek safety outside of traditional financial assets. Right now, the market is adjusting, and we're seeing shifts in these money flows. That's why it's crucial to identify what kind of economic regime we're transitioning into, because that will shape investment strategy moving forward.
So if we assume the market is having a heart attack, how do we figure out if it's a mild one or something more serious?
Actually, it's not about intensity. A market downturn, no matter what kind, is always bad if you're not prepared for it. The key isn't determining how bad the situation is, but what kind of downturn we're dealing with. We categorize market heart attacks into two distinct types based on the economic regime. In type A, we're dealing with a deflationary slowdown, a scenario where the Federal Reserve's interest rate hikes successfully slow the economy, inflation cools, and government spending is kept in check. It's still a painful environment, but the impact is more about economic stagnation rather than runaway price increases. In type B, we have an inflationary crisis where inflation doesn't go away, supply chain pressures persist, or tariffs push costs higher globally. Here, the challenge is different, but not just slowing growth, but rising costs that eat into corporate profits and consumer spending power.
So both scenarios are bad. But what changes is how you protect your portfolio.
Exactly. In type A, the focus is on holding more bonds and defensive assets, since interest rates are stabilizing and economic activity is slowing. In type B, traditional hedges like bonds might not work as well, and you'd want more exposure to commodities, real assets, and inflation resistant investments like gold. Right now, we're evaluating which type of scenario we're heading into. The good news, it's too early to assume the worst. The key is being prepared for both possibilities and positioning portfolios accordingly.
All right, I know this is the question on everyone's mind. Can we avoid a full-blown crisis?
That's the big question. And in the previous slide, we talked about the two different types of market downturns, both of which can be painful but in different ways. Whether we're dealing with a deflationary slowdown, type A, or an inflationary crisis, type B, the challenge isn't about avoiding market cycles altogether. It's about preparing for them. Here's the honest answer. The odds of completely avoiding downturns are low. History tells us that markets move in cycles, and periods of rapid growth almost always lead to corrections. The real question isn't if a downturn happens, but when.
Which makes it dangerous to try to time the market, right?
Exactly. Timing the market is risky because you have to be right twice, right? When to get out and when to get back in. That's why successful investing isn't about predicting every downturn. It's about building a portfolio that can survive and thrive through any cycle. If we do see a soft landing where the Fed controls inflation without triggering a major recession, it will likely be because of strong government investments in areas like infrastructure, AI, and energy. But historically, soft landings are rare, and that's why managing risk proactively is critical.
All right, so we've talked about the market. But what about investors? How should they be thinking about their portfolios right now?
This is where my stock DNA's models come in. We've already been positioning for this shift. But before we dive into specifics, there's an important principle behind our approach: the balance between prediction and reaction. A lot of investors think they need to predict exactly when a downturn will happen. The problem? No one can do that consistently. Instead, what works is a system that, in addition to prediction, also reacts without emotional bias when the prediction is not correct. That's exactly how Darwin, our AI model, is designed. It doesn't just make static predictions, it reacts dynamically, assessing market conditions and making adjustments based on data. Our conservative models were already holding 26% cash before this latest drop, which means they were in a defensive stance early on. As volatility increased, we've been shifting even more toward cash and risk off assets, ensuring that these portfolios remain stable while the market sorts itself out. For our aggressive models, we're dialing back exposure to high beta and leveraged stocks, since these get hit the hardest in uncertain markets. Instead, we're increasing holdings in defensive sectors like utilities and consumer staples, areas that tend to hold up better during economic slowdowns.
So the idea is to shift when necessary, but not panic?
Exactly. The worst thing investors can do right now is make emotional decisions, panic selling at the wrong time, or chasing rebounds too early. Instead, the key is to follow a strategy that adjusts to risk automatically.
And that's what makes the difference between getting stuck in a ditch and staying on course, right?
Exactly. Winning by not losing isn't about avoiding all volatility. It's about avoiding the deep drawdowns that take years to recover from.
All right, so we've talked about how the models react, but how do end clients, whether they're individual investors or financial advisors, typically respond to a market drop like this?
That's a great question because investor psychology plays a huge role in how portfolios perform over time. When the market drops, it's not just numbers on a screen, it's real emotions, real money, and real decision making pressure. This slide helps visualize how different types of investors react based on their portfolio positioning.
Walk us through it. What's happening in this chart?
This is a fear and greed analysis of the UMAI growth portfolio. It's based on how the portfolio performs relative to the S&P 500 in different conditions. The chart is split into four key emotional states. Ecstatic. The market is down, but the portfolio is up. These investors are feeling great because they've avoided losses. Happy. The market is up, and so is the portfolio. Investors are comfortable and optimistic. Fearful. The market is down, and so is the portfolio. This is where panic sets in. Greedy. The market is up, but the portfolio is underperforming. These investors feel like they've missed out on gains. Right now, after this market drop, most investors are in the fear zone. They're seeing red in their portfolios, and their natural instinct is to either panic sell or freeze up.
That makes sense. But different types of portfolios probably experience different levels of fear, right?
Exactly. The type of portfolio you hold determines how much fear or relief you feel in a downturn. Clients in conservative defensive portfolios, the ones with more bonds, cash, and defensive stocks, are probably feeling slightly relieved that their losses aren't as bad as the broader market. They're down, but not nearly as much. Clients in growth or aggressive portfolios, the ones holding high beta stocks, are likely feeling more anxious because their losses might be greater than the market itself.
So, in a way, this is a test of an investor's risk tolerance. Those who were comfortable taking more risk when things were good might now be questioning if they took on too much.
Absolutely. And this is where the worst mistakes happen when investors let short term fear drive long term decisions. Panic selling at the bottom locks in losses and makes it harder to recover when the market eventually rebounds. That's why it's critical to stick to a plan, adjust risk exposure gradually, and not make emotionally driven moves.
All right, so we've talked about how investors reacted to the drop, but the big question now is what happens next? Where do we go from here, and how will end clients react in the coming months?
That's exactly what everyone wants to know. Right now, we're at a critical turning point. The market has pulled back, and now we're facing two possible paths. Recovery, the market stabilizes and rebounds, restoring investor confidence. Heart attack, the decline continues, triggering more fear and risk off behavior.
All right, we've covered the possible market scenarios. But now, let's talk about the emotions that will drive behavior moving forward.
That's right. We're now at a critical emotional turning point for investors. The next few months will dictate whether they feel ecstatic, relieved, or frustrated, and those emotions will determine their actions.
So let's break it down. What happens if the market continues to drop?
If we see a continued decline, something interesting happens. Some investors, particularly those who took defensive positions early, will actually feel relieved or even ecstatic. Why? Because they avoided bigger losses by positioning defensively. They feel validated in their risk management decisions. These are the investors whose portfolios are in the ecstatic or relieved zones on our fear and greed chart, meaning they've protected capital while the broader market fell.
That makes sense. But what about if the market recovers?
That's where greed kicks in. If the market bounces back, investors who went risk off too aggressively might feel left behind, wishing they had more exposure to high growth assets. That's the classic FOMO, fear of missing out effect. On the chart, these are the investors who end up in the greed zone. They see the market rising, but their portfolios aren't keeping pace, leading to frustration. And that frustration can lead to rash decisions like jumping back into the market too late, chasing returns, or taking on too much risk just as volatility returns.
So, no matter what happens, there's always an emotional challenge.
Absolutely. The key takeaway here is investor emotions don't disappear, they just shift based on market direction. Whether it's fear, relief, greed, or FOMO, emotions will always influence decision making. That's why at My Stock DNA, we remove the emotional component from portfolio management. Instead of reacting impulsively, our models adjust risk automatically, helping investors avoid the classic mistakes of panic selling on the way down or chasing returns on the way up.
That's a great way to wrap things up. So, for investors listening, what's the final message?
The final message is this: stay disciplined. The worst investment decisions come from reacting emotionally to market movements. The best ones come from following a structured approach that adapts to different conditions. For financial advisors, this is also a crucial moment to educate and reassure clients. It's not about telling them everything will be fine. It's about showing them how market cycles work, reinforcing the logic behind their portfolio construction, and making adjustments where necessary without overreacting.
That's the perfect note to end on. Thanks for joining us today. And to our listeners, stay focused, stay disciplined, and remember, winning by not losing is the best strategy of all.
Alright, let's switch gears and talk about how the UMAI portfolios are actually constructed.
Yes, that's an important topic. Every month, we go over this section, particularly for advisors who are new to using model.
So, it's kind of a refresher, but also essential for anyone just getting started with UMAI.
Exactly. And we always recommend that advisors view this content alongside the My Stock DNA introduction video. That video is available on the UX Wealth website, and it really helps tie everything together.
It's good to have that video as a foundation before diving into how the portfolios work. The UMAI models are core strategies designed by the My Stock DNA team. Darwin allocates funds between complementary stocks and strategies, aiming to manage risk while still seeking growth.
The UMAI models are designed specifically for financial advisors. These models provide flexibility for advisors to match different client risk profiles, making them a go-to solution for balanced, risk-managed portfolios.
Alright, let's dive into how UMAI portfolio compositions are determined. Looking at this slide, it seems like we've got different risk levels and strategies in play.
That's right. If you look at the bottom section of the slide, it breaks down the different portfolios available: aggressive, growth, moderate, and conservative. As you move from left to right, the portfolios shift from higher to lower risk. So, aggressive targets a higher risk profile, while conservative is built to meet.
Got it. And the strategies in each portfolio, aggressive, market neutral, and defensive, are designed for specific market conditions?
Exactly. Each strategy has a role. Aggressive strategies are highly correlated with the market and seek growth. On the other hand, defensive strategies are meant to protect the portfolio by having a low or even negative correlation with the market. And in between, market-neutral strategies aim to balance risk and return.
These compete for allocation based on performance. But what determines their performance?
That's where the asset classes come in, which you can see in the top section of the slide. On the far left, we have the riskier assets like leveraged ETFs and crypto ETFs. As you move to the right, you get safer assets like bonds, US dollar ETFs, and cash. Each strategy can dynamically allocate across these assets based on performance and risk levels.
As market risk increases, more allocation would move to the safer assets, like bonds or cash on the right side of the slide?
Exactly. And when risk decreases, allocations shift towards riskier assets, like those on the left, such as stocks or leveraged ETFs. Darwin, the AI, makes these adjustments on a weekly or monthly basis.
It looks like the portfolios really evolve based on how these strategies and assets perform, keeping everything balanced for the user's risk tolerance.
Yes, and that's the key. Advisors can choose the portfolio that fits their client's risk profile, and the system will optimize it over time, ensuring that the strategies adapt to market conditions.
Continuing from the last section, let's talk more about how the portfolios adjust based on market conditions. I think this is where the real magic happens, right?
Absolutely. The key thing to remember is that the allocations in the portfolios are always determined by the perceived risk in the market. So when market risk is high, you'll see the allocation shift toward the right side of the slide, favoring more defensive and market-neutral strategies.
And those strategies tend to invest in safer assets, like cash, bonds, and gold.
Exactly. Those safer assets, things like US dollars, bonds, gold, are where the defensive strategies focus their allocations. This shift helps manage risk appetite, especially in more volatile times.
So as we move from more aggressive to more conservative portfolios, the risk levels are adjusted based on the strategy, right?
Right. Aggressive portfolios will typically allocate a higher percentage to more aggressive strategies, which lean into riskier assets like stocks or leveraged ETFs. Meanwhile, the conservative portfolios focus more on defensive strategies that favor those safer assets. The system is essentially built to align with the risk tolerance of each portfolio.
And I'm guessing this isn't a set it and forget it situation. There's constant rebalancing going on?
Exactly. The rebalancing happens on a monthly basis, shifting between risk-on and risk-off assets depending on how the market is behaving. It's all driven by perceived market risk, so when the market looks unstable, the portfolios adjust to protect the investor.
It's fascinating how it all dynamically evolves with market conditions. Thanks for breaking it down. Now that we've covered how the portfolios adjust, let's dive into the strategies themselves. I see some of them use leveraged ETFs.
Yes. The ones with a star next to them are the strategies using leveraged ETFs, but they're only available in specific portfolios, like the UMAI Modulated Growth Portfolio with leveraged ETFs. So, they're not included in every portfolio, just those designed for more risk.
That makes sense. What about the other strategies? Some seem aggressive, while others are more defensive.
Exactly. The aggressive ones are designed for growth and tend to move with the market, whereas the defensive strategies are meant to be negatively or minimally correlated with the market. These provide protection when things get volatile.
Neutral strategies, they're designed to have almost zero correlation with the market, right?
Yes, they're specifically designed to minimize correlation with the market, offering more stability regardless of market conditions. These strategies help keep the portfolio balanced.
So, all these strategies, whether aggressive, market neutral, or defensive, are essentially competing for allocation within the portfolio?
Exactly. They all compete based on performance, and the performance metrics for each strategy can be viewed with a 15-minute delay on the website.
Having near real-time data to track how each strategy is doing. Thanks for that explanation.
Now, let's cover some key disclaimers about these models.
First, they don't use small-cap stocks, naked shorts, options, or futures. There's controlled use of leveraged and short ETFs in selected portfolios.
Another point, these models are optimized for monthly volatility, not daily. That means while daily drawdowns might appear higher, the monthly figures show the true risk level.
And remember, the models are designed to be boring, like a roller coaster built for kids, meaning it's all about smooth, steady growth rather than wild ups and downs.
Exactly. And when it comes to risk, think of it like driving on icy roads. Sometimes it's better not to drive at all than take the risk.
Before we wrap up, for anyone who's interested in diving deeper into what we talked about today, there's something worth checking out.
Here comes the shameless plug. But seriously, if you're curious about how Darwin works, Sudhir Halla, the CEO, has written a book that covers it all. It's available on Amazon.
And if you follow the book closely, by the time you hit the blindfolded chimp chapter, you'll be beating the S&P 500 on your own. No need to rely solely on AI.
Exactly. It's all about empowering you to make better decisions, with or without the help of technology.